All right, good morning, everybody. My name is Nick Olson. I'm Director of Private Wealth here at Kathmere Capital. Today, we're excited. We're going to do our second quarter recap of really the market and the economy. Nick Ryder, our Chief Investment Officer, is on, and he'll be hosting this. I'm going to be in the background watching for the questions, for the Q&A, and just any comments or anything that you guys have. So please do use those, and I will be following those, and then we'll answer those questions at the very end. So, Nick, I think you're there. If you can take over from here.
All right. Good morning. Thanks, Nick, and thank you everybody for taking the time to join us today. As Nick mentioned, second quarter market economic update. We'll kick things off, provide brief update on what's been going on in global capital markets, things impacting your portfolios. Also review a handful of economic developments, and then as well as a few other topics or topical topics of interest or things that we continue to watch and monitor that we thought might be worth sharing today. So fair amount to cover today, so we'll go ahead and just jump right in with a market summary update here. So what we'll show on the slide here is just performance of what I'll call the major asset classes, both across stock and bond markets over a variety of time periods, really focusing in there on the second column from the left-hand side. We can see second quarter, very good one for global equity investors. We see U.S. stocks up north of 20% on the second quarter, bringing year-to-date performance just to slightly in the red. International and emerging market stocks, again, solid performance in the second quarter, not quite matching the very impressive results from the U.S. side, and lagging a little bit on the year-to-date, down close to 10%, but nevertheless a very strong recovery there during the second quarter for international as well. High-yield bonds then, we can see up north of 10% during the second quarter, as many of you are likely well aware. We did add an allocation to high-yield bonds into applicable client portfolios during the second quarter, so that's been an allocation that has paid off nicely, and you can see bringing, again, year-to-date losses to pretty modest levels. On the investment grade bond side, we show a broad market index as well as an index focused on shorter term bonds, and you see both decently positive, albeit much more muted returns during the second quarter, but on the year-to-date basis, again, providing healthy returns, very much demonstrating the role of providing ballast and stability in a portfolio during otherwise turbulent times. We'll get a bit more into that in later slides. And then the last row there, Treasury bills represents essentially cash, very short-term lending to the U.S. government, generally what would be considered a risk-free asset. You see returns basically rounding to zero during the second quarter, not surprising with where short-term interest rates are as a monetary perspective, something we'd expect to kind of remain anchored near that zero bound for quite some time here. This slide here, just putting some context into the very impressive results we saw for the S&P 500 index. We actually saw the best quarter since 1998. You see the fourth quarter since 1998, up slightly north of 20% in the second quarter. And really we're contrasting here is a tale of two quarters here in 2020. We've had the best of times and the worst of times. Both the second quarter ranked as the sixth best calendar quarter for the S&P 500, dating back to 1936, and that incidentally came right on the heels of the sixth worst quarter since 36 there, as we all remember the dark days of the first quarter with the market off nearly 20%. Interesting though, this is something you do see periodically as a term for it, is that volatility tends to cluster, and so oftentimes you do see very bad periods followed by very good periods, and conversely, as kind of these high volatility periods do kind of have a way of presenting both good and bad times very closely together. This slide here just provides a little bit additional context in performance through 2020, breaking it into really what I'll call the three main sub-periods of the year, and then all the way to the right we see the cumulative year-to-date results, which mirrored what we saw on the first page. But we start off the year really with the first 8 to 9 weeks there, from January 1st to February 19th, and U.S. stock markets had grinded higher. The S&P at the time was actually up nearly 5%. We had moved to an all-time high. If we recall, this happened in the face of some of the first news about the outbreak of the coronavirus started to emerge in the middle of January, and markets were initially kind of shook by it and then did continue to grind higher for a little bit. You see international emerging market stocks more or less flat, and same thing with on the bond side. But things, as we all know, started to turn sharply there in the later stages of February, and over a 5-week period had a rapid decline in markets with global stocks, broadly speaking, declining nearly more than 30%. You can see high yield bonds actually sold off by 20%. It is one of the reasons we do look at high yield bonds or junk bonds, so to speak, as more of a return generating asset, given the considerable volatility they do exhibit in the sensitivity to equity markets. Importantly, there you see then what I alluded to earlier was investment grade bonds, both of the broad market persuasion as well as short term, did hold up, relatively speaking, quite well during this stressful period, delivering flat returns, kind of exactly the role we'd expect bonds to play during a crisis environment of providing that ballast and stability. Market ultimately bottomed there in March 23rd. Incidentally, that was a date really that week between St. Patrick's Day and the 23rd is when we had a lot of policy announcements, something that we'll get into shortly. But massive announcements in terms of both fiscal and monetary stimulus had the effect of, I think, as I described it, really taking a Great Depression-like scenario off the table, or making a very low probability outcome. And you saw markets respond with a sharp turnaround. You've seen U.S. stocks there from that last week of March through the end of June, up nearly 40%. International, as we saw, gained strongly as well. High yield bonds are 20% recovery from the trough. And then investment grade bonds also providing some positive returns as credit spreads tightened, which we'll also speak to shortly. And then finally, you kind of see the tale of three segments there, summing up to what it did. And it's interesting, if an investor had fallen asleep and not paid attention to the news or not looked at their statements, you could have opened your second quarter statement and said, pretty boring. Your stocks are down slightly, international's down, but bonds are up. But as we know, there's a lot of volatility underlying there. This chart just included in here to, one of the things, or maybe a misconception I've heard from some out there, was that things were very disorderly during the market sell-off, and I actually think there was a fair amount of rational, so to speak, response during the dark days of the sell from February 19th to March 23rd. And so, just breaking the U.S. market into the 11 sectors, and we've arranged them from left to right based on how significant or how negative their returns were during the initial sell-off phase. And what you see is, on the left-hand side, segments of the market that were, from an economic standpoint, very dramatically impacted by the developments happening in the world as the coronavirus crisis kind of kicked into play, and we saw energy prices way down. So you see some of the more cyclical sectors like energy, real estate, industrials, financials, materials on the left-hand side, and conversely, those sectors that were more, I'll call it, relatively speaking, insulated from the troubles, or potentially even positioned to do well in such an environment, held up much better in terms of consumer defensive stocks, healthcare and technology, as well as even services. So there was some order in the sell-off. The next period there, we do show what I'll call the initial stages of the rapid rally, and you see essentially a mirror image of what we saw during the sell-off. A lot of those most beaten down stocks recovered extremely sharply, and less so for the ones that didn't go down as much. And then that third stage there in the blue bars, more similar to what we saw in terms of relative sentiment during the initial sell-off, which I'll kind of describe this as the consolidation phase, where, hey, we moved past the initial kind of technical rebound with all of this and moved into a stage where I think more rational analysis started playing out, more of a recognition that a V-shaped, so to speak, recovery was less likely outcome. And as we'll talk shortly about, markets starting to price in maybe more of a choppy, ultimately, what's often described as a Nike swoosh-shaped type of an economic recovery. And you've seen some of these more defensive sectors hold up slightly better in the environment, and more of the cyclicals give back some of their gains. This slide here just provides a summary of what we call active equity, active index style performance. So, factors or smart beta as they're described. So some of the styles that are in play in our clients' portfolios. And we show up both in the US as well as international markets. Very briefly, just to go here, we focus on the US side. We see the value very much struggle during the second quarter and particularly on the year-to-date basis. So we show that in the gray line there for U.S. stocks would be the S&P 500, and then the performance of the various kind of active index styles. So value trailed. Basically, cheap stocks continue to get cheaper, and expensive stocks continue to get more expensive. On the flip side of value was kind of its opposite, which is momentum. So what's been doing well recently continued to do very well. And you see during the second quarter, momentum outperformed by a decent margin, in particular on the year-to-date basis. Quality and minimum volatility generally considered two more of the defensive ones. So quality focusing on stocks of companies that are highly profitable, good margins, strong balance sheets, minimum volatility, those stocks that tend to be less volatile, as the name suggests. And what you see is, not unusual to see during a strong recovery, kind of quality, fair, and min vol to trail a little bit. A bit anomalous, I'd say, for the full year-to-date period, although you can see the absolute magnitude of their underperformance relative to the broad market, relatively limited. But nevertheless, quality and minimum volatility probably didn't hold up quite as well as we would have expected. And then small size, you can see small caps, more cyclical in nature, I'll call it, generally speaking, riskier companies did do very well during the sharp rebound in the second quarter, and year to date have lagged pretty significantly. So all in all, on the U.S. side, I'd say it's been a mixed bag for factor investors or active index styles. Momentum really standing out well, generally not doing quite enough to pull up some of the lag from the others. On the international side, though, I would say things fared a little bit better. Thematically, generally the same, with you can see value lagging, momentum outperforming. Quality actually held it up a fair amount better, either delivering market-like or outperformance for the quarter and the year-to-date. Minimum volatility did lag a touch, but not so dramatically on the year-to-date. And then small cap, again, delivering some outperformance in the second quarter, and just a modest underperformance for the year-to-date. One of the things we have been watching, and this will mirror in many respects some of the underperformance on the year-to-date and longer-term period of both smaller companies as well as value stocks, which is the performance of the average stock as represented here by an equal weighted index. So if you think about the S&P 500 index, the traditional index is cap weighted, whereby stocks are weighted in the index by their total market capitalization outstanding and done so proportionally. So whereas Microsoft, the largest stock in the index, is 6%, on an equal weighted index, Microsoft has the same 0.2% weighting as the other 500 stocks. And what this chart here shows is on rolling 1-year periods, the performance of the equal weighted index versus that of the traditional cap weighted S&P 500. And what you can see is over the last year there on the far right hand side, the equal weighted index is lagged by 11% as of the end of June. We can see that stands in contrast to the longer term 30-year track record here, where the equal weighted index is outperformed by nearly 2% a year. But this is really just representative of the fact that the market has been very much so carried by a handful of very large cap, or I'll call it mega cap growth stocks. When you think about the S&P, some of the largest names have been the best performers in recent months. So things like Microsoft, Apple, Amazon, Facebook, Google, all those largest names in the market have done extremely well. And the fact that they have such a large weighting, so those top stocks I just listed there cumulatively account for nearly 22% of the index. And so the fact that they've done well, they've been able to, I'll call it, mask a lot of the underlying or some of the weakness on the average stock in the market. And so that does go a long way to explaining why I think some people feel a seeming disconnect between the stock market's very strong performance there in the second quarter, or and even from just being down 3% in a very challenging economic environment, the fact that you have had a handful of very largely weighted stocks in the index continue to perform well has been able to mask a lot of the weakness maybe kind of that's happening at the average stock level. One impact of the continued outperformance of these largest names in the index has been that you've seen the market become, the cap-weighted index or the market as a whole become increasingly concentrated. So what we plot here, and this is a chart from Dimensional Fund Advisors, shows the weight of, in the gray line at the bottom, the largest stock in the U.S. market. The middle line there represents the weight of the largest 5, and then the top line is the cumulative weight of the largest 10. And what you've seen is, concentration across all of these measures, particularly the top 5 and top 10, has increased pretty significantly in the last, call it 4 years now, as large cap growth has really kind of run away with the market. And we see the largest 10 stocks now, they're approaching 25% of the U.S. market, which is, levels we have not seen since the late stages of the tech bubble in the late 90s and into early 2000s. What's important to also note, though, here is that while elevated versus recent experience, and even that through the 70s and 80s, there have been periods in historical past where the market was actually even more concentrated than it is today. So this is a chart. This is something that we continue to think about internally and debate what are the implications of this. I did mention one of them earlier where it helps to explain how the market has held up better than I think many would have expected through the year-to-date period. The flip side of that is that I would say it also introduces a source of risk into the market, that if you have some of these large cap, mega cap growth names, as I mentioned, the Microsoft, Apples, Amazon, Facebook, Googles of the world, to the extent they fall out of investor favor, they have some trip ups, that it could pose a sense of risk for the overall market indexes. The flip side of that is it certainly, in our perspective, strengthens the case for alternative weighting mechanisms or alternative strategies like some of those active indexes that we talked about, which consider factors broader than just simply market cap weighting. So we think that those stand to do well in the years ahead if something does reverse in this trend. And the other side of it that we look at from a concentration perspective is, in light of value's continued underperformance as a strategy in recent years, and which is now running on pretty historic levels. One of the criticisms of value by some is that value does not stand to work in an environment of, an increasingly winner-take-all monopolistic type environment. And while that stands to reason, and logic there seems compelling at first blush, the historical data does not bear that out, as we see on this chart alone, that during periods in the past, you've had far more concentrated markets, you've had far greater presence of monopolies in the market, and yet we know that over the very long haul, value has demonstrated to be an effective strategy. It's not shown on here, but we can show certainly that value did very well actually through the 40s and 60s during this period of actually far greater concentration in markets than we see today. So it's something we're continuing to evaluate with a lot of the implications of this, but thought it was just interesting to share and preview with you all today. Turning now to the interest rate side of the world. So this chart plots U.S. Treasury rates of various maturities from 3 months to 30 years. And we look back at the beginning of 2019, you can see, broadly speaking, rates in the 2.5% to 3% range. Fast forward now 18 months, and the world is quite a different place, with the shortest of maturity interest rates, so the 3-month and 2-year rates, approaching 0%. Even 10-year U.S. Treasury bonds yielding just about 65 basis points, are 0.65% at the end of the quarter. Even the 30-year U.S. Treasury bond now yielding less than 1.5%. And what you've seen happen really is, a combination of effects has caused this. I'd say first and foremost has been, particularly when you think about the 10-year Treasury, a flight to safety, or investors seeking what are called safe haven assets like U.S. Treasury bonds during a period of crisis. And so you see that that chart or the lines turn sharply downward as rates dropped, nearly a full percentage point during the depths of the crisis before kind of settling in. The other side on the fixed income market, so this chart plots credit spreads. Credit spreads just are a measure of the price of default risk. You can think about them as the extra yield demanded by bond investors to invest in bonds with default risk in excess of that of investing in a treasury bond. So in order to invest in a risky corporate bond relative to U.S. Treasury bond, investors rightfully demand compensation in the form of additional yield for doing so. And credit spreads just measure what that additional compensation is. And so when it's lower, it means that investors are more willing to bear credit risk, are less concerned about the prospects of future defaults. And when they sell off these riskier bonds, that's when you see spreads widen. And it just means investors are acquiring additional compensation for holding riskier bonds. And so we plot here on the green line investment grade bonds. On the blue line represents high yield bonds or junk bonds. And you can see that during the crisis period, spreads widened considerably, reflecting very much increased fears of corporate bond defaults. You have seen then these spreads kind of retrace some of their lost ground. As we've mentioned to you all in commentaries in the past, and certainly in client meetings as well, we did take opportunity during the spread widening environment where we thought both investment grade and high yield bonds had become attractive from a valuation perspective, and that they were offering pretty high yields or attractive yields in our perspective. We did take an opportunity to add in high yield bonds towards the later stages of April. So not quite at the cheapest, but after some recovery had taken, and you've seen the recovery has continued over the last couple of months, as witnessed there, as we saw with the 20% returns in the high yield space during the second quarter. Looking forward, we continue to think high yield bonds offer an attractive option for the right investors. And so, and what we look at here is that high yield bond returns over what I'll call the intermediate term or 5-year periods tend to closely track what the initial starting yield is with which they were bought. And so this relationship is held through, I'll call it, crisis periods when yields and spreads are very wide. It's also held during, I'll call it, more benign times when yields were tight and you weren't receiving a lot of extra compensation for investing in them. But when we just show various periods, and this is a chart from AllianceBernstein, various periods, what the starting yield was on a high yield bond index and what it ultimately returned over the subsequent 5 years on an annualized basis. And you can see these numbers match up pretty darn closely with one another. You look as of the end of June, this index is yielding close to 7%. That would, all else equal, suggest that's kind of what investors should expect over the coming 5 years on an annualized basis. And we look at that in an environment where, as we mentioned, 10-year Treasury bonds are trading at offering 70 basis points of yield or 65 basis points of yield. The opportunity to gain 7 seems relatively attractive to us. Again, even relative to equities, we think it could be an attractive option as equities with valuations where they are. I would say 7% return expectation in the next 5 to 10 years is a reasonable one as well. So we do think there is some good opportunity in high yield, and we'll continue to hold in client portfolios for the foreseeable future. Turning now briefly just to the policy response. I did mention in earlier slides that largely attribute the market's strong recovery to the massive amounts of both fiscal and monetary stimulus that were enacted by policymakers at home as well as abroad during the depths of the crisis there in late March. So we'll talk a little bit about both pillars. So again, fiscal policy enacted by Congress via the U.S. Treasury. Monetary policy remains the realm of the Federal Reserve. Jointly, they kind of work to, at the same goals, but operating through different avenues. So starting on the fiscal side, many of this will be very familiar to all of you. some of the stimulus response we've seen via Congress and the Treasury. We've seen direct stimulus checks, so the $1,200 checks being distributed to adults, subject to certain income phase outs. We've seen the expanded unemployment benefits. That's gaining a lot of press in conversation right now, as those are set to expire at the end of the month. We'll see to what extent the government or Congress is able to pass additional measures. There's a lot of debate about whether or not that's warranted going forward, and what that may look like will ultimately be decided in the next handful of weeks. We also saw within the broad stimulus bill, the CARES Act, as it's called, you saw loans and grants to small, medium-sized businesses. So the Paycheck Protection Program for small businesses, the Main Street Lending Act in the case of medium-sized businesses. Again, seeking very much to tide businesses over, to provide them liquidity to continue to pay their bills, to hopefully pay their workers during the crisis period where public health was prioritized and we wanted people to stay home. You also saw loan and loan guarantees to certain sectors of the economy. This is, very much the grants or the loans being given to the airlines, to various, airline manufacturers like Boeing, for instance. We also saw business tax provisions, direct support for state and local governments, as we know that many state and local governments have balanced budget amendments. Provide support was given to them to hopefully enable them to keep people on their payroll and continue to provide vital services that we all rely on from state and local governments. And then healthcare related spending was another part of it. What we've seen here is, a couple of things. So first and foremost, the response was, broader than just that of the U.S. government. So I just mentioned the U.S. government side, but we also saw similar responses in Europe by various governments in the Euro area, the UK, Japan, and to a lesser extent, China. But also from a size perspective, very significant. So all told, we've seen about $3 trillion of fiscal spending from the U.S. government. That's amounted to about 15% of GDP. There have been some of the other what are called liquidity provisions that further the stimulus response. And on the bottom side of this chart here, we see that one byproduct of this has been exploding fiscal deficits by government. So the U.S. government last year in 2019 ran a deficit amounting to about 5% of GDP, roughly $1 trillion deficit. This year we are looking quite possibly at a deficit in the range of $4 to $5 trillion, as the government is basically spending money without bringing in offsetting tax revenue. A result of this, and something we'll continue to watch and we continue to study and try to assess what the implications are, is a massive increase in the amount of U.S. government debt outstanding relative to the size of the economy. We are on track basically by the end of this year to see outstanding debt reach close to 20 trillion, which is about 100% of gross domestic product or annual output for the U.S. economy. And this is up sharply from where we sat last year at roughly 80%. And you can see the number approaching levels really not seen since the massive deficit spending used to finance World War II. And these are forecasts for both Goldman Sachs as well as the Committee for a Responsible Federal Budget, nearly line up with one another, projecting even further increases out into 2023 and beyond. So certainly there are some concerns about the sustainability of running massive deficits year in and year out. This could be subject for an entire webinar on its own, but it is something that we're concerned about, is the fiscal trajectory of the U.S. government. It's certainly concerning. That doesn't mean that the stimulus wasn't warranted or wasn't effective. We think it was certainly appropriate given the crisis we face. If you think about prioritizing public health was requiring that people stay home, it seemed only right and fair that the government would then replace the lost wages for many of those that were unable to work or unfortunately lost their jobs during the crisis period. The bigger concern is that we were probably on an unsustainable track to begin with, and so this is only exacerbating the problem, widening the problem that we think does need to be addressed in the future when this crisis is behind us. There is one, I guess, bright side to the the massive explosion of debt outstanding, and that's the cost to service it has actually fallen and will likely continue to fall, and that's simply because interest rates, as we talked about, have moved to historically low levels. So having lots of debt outstanding when interest rates are zero or near approaching zero makes the burden more sustainable, so to speak. It doesn't mean it's free. Eventually, it still does need to be repaid. So it's pushing it out into future generations or future time periods at a minimum. However, the annual budget cost of carrying that debt is relatively limited when you have very low interest rates to do so. And so you see the interest expense borne by the federal government in 2019 was just less than 2% at 1.8%. If you think about projections going forward, can call for us to actually come down lower if interest rates remain lower. It also highlights some of the risk here, which is that were interest rates to move sharply higher, you could get yourself into a very negative kind of vicious cycle where outstanding debt then requires higher and higher interest payments to sustain, which makes further deficits and further debt warranted, which can just put you on an even more unsustainable track, which is part of the reason why, in our view, that this is, the massive amount of outstanding debt is concerning in the sense that it does put some constraints on the government and makes us more vulnerable to a variety of factors. But so something we'll continue to watch and think through what are above all else kind of the investment implications for our clients. The monetary policy side, we covered this in a webinar previously, but broadly speaking, we can kind of boil down the Federal Reserve's response into three main buckets. So we saw rate cuts. So the Federal Reserve has the power to control interest rates at the very short end of the yield curve. I think what they control is the federal funds rate, which is the rate at which banks lend to one another on an overnight basis, and the Fed has the ability to control that. And so Fed cut interest rates from near 2% down to zero very quickly during the onset of the crisis. On the bond purchases side, I'll call it both traditional and non-traditional bond purchases. So historically, the Fed has also conducted its monetary policy through open market purchases of treasury bonds, as well as then mortgage-backed securities were introduced during the financial crisis. And now, as we kind of move into an additional realm, you've seen the Fed purchase things like corporate bonds, asset-backed securities, trying to support the flow of credit across the broader swaths of the economy. And then liquidity support, a bit more of an arcane side of things at the Federal Reserve, but really focusing on supporting smooth functioning within credit markets. So they took some actions within things like asset-backed securities, within money market funds, as well as providing some support to central pieces of infrastructure within the trading atmosphere. All in all, I'd say that the policy response is similar to what we saw on the fiscal side, very significant, very rapidly implemented. This chart here from JP Morgan, I think, does a great job summing it up, just how quickly and significant the Fed's policy response was this time. We've talked in the past about, I think, we all benefited greatly from, in some respects, the Fed having gone through the global financial crisis. They were able to, quote unquote, dust off a playbook built during the financial crisis and rapidly implement measures that took time to work out the last time around. So what we see here on this chart is just the Federal Reserve's balance sheet. You can think about when, for instance, I mentioned the Fed conducts its open market operations and buys bonds in the marketplace. What means or what happens there is when the Fed buys a treasury bond outstanding in the marketplace from a bank, they add a treasury bond to the asset side of their balance sheet, and they add an offsetting liability in the form of U.S. currency on the liability side. And what you see is the massive expansion of the Fed's balance sheet here on the asset side. You can see basically taking their balance sheet from roughly $4 trillion to just north of $7 trillion in the span of weeks during the March and April timeframe. And you can see that during the global financial crisis, the Fed took its balance sheet from roughly $1 trillion to just slightly north of $4 trillion, so adding $3 trillion to its balance sheet over the span of closer to 6 years. So Fed was able to do in 6 weeks what it took 6 years to do previously, and I think this has had a significant impact on how quickly markets have been able to rebound and how much the tone turned in among market participants from pessimism to optimism and pretty quickly. Looking now just to the broader economy, there is no precedent. The word unprecedented seems to be thrown around a lot lately, and for good reason, which is there is no precedent for the scale of the economic contraction the economy is experiencing or has experienced, as well as then just the speed at which things happen. And so what we plot here is just quarterly change in GDP growth. And we see that during the first quarter, real GDP declined by 5% on an annualized basis. The second quarter number is going to be released in 2 weeks at the end of the month. And estimates, the kind of central estimate these days is calling for GDP to have declined at an annualized pace of roughly 35% during the second quarter. You can see that going back to as far as data is available, it just is off the charts in terms of negative. Now, it's important, I could have also plotted estimates for third quarter GDP show a gain somewhere in the 20 to 30% as well. So you're about to have the worst quarter ever and likely followed by the best quarter ever. I joke with some of these economic figures in terms of unprecedented. Analysts are going to be struggling or trying to make charts going forward as just y-axes need to be entirely reset in terms of both the negative and positive numbers we're going to see during this episode. One of the things, there's have been clear signs of recovery in the economic data. So on the left-hand side, we just, as one example of this, focusing on the labor market, plot monthly change in payroll employment. So this is, the jobs report, so to speak. And you saw north of 22 million jobs shed during March and April. The National Bureau of Economic Analysis and Research, the official recession dating committee, stated or announced that recession had officially begun in March. And you see, it's quite possible that we are going to have, the deepest and the shortest recession on record, in the sense that massive job losses in March and April, and we've seen signs of recovery there with north of 7 million jobs then added cumulatively in May and June. So it's hard to argue that a recovery has not taken hold, given the massive job gains that we saw. And you've seen initial claims for unemployment insurance continue to decline from after peaking in late May, March, and early April. You've just seen a steady decline. And today's number just released earlier this morning, incidentally, was very similar to that. So you've kind of seen a plateauing there in terms of initial claims for unemployment insurance. Again, showing signs of recovery in the market, showing that the recovery has taken hold. Looking forward, what we plot here is this is a chart from Vanguard. This just shows Vanguard's baseline forecast for various economic blocks, the expected path of GDP, just showing U.S., Euro area, China, and the UK, orienting everything to a level of 100 at the end of 2019. And you see basically a similar trend, although varying degrees of recovery and drawdown in the blocks, but a sharp decline in economic activity, loss in output during the first 2 quarters of the year, followed by varying degrees of recovery. And this is where I mentioned earlier, kind of a swoosh-shaped recovery, where you're seeing a sharp initial decline and then followed by a recovery. I heard the president of the Philadelphia Federal Reserve Bank kind of described it as, in his forecast, as a Nike swoosh-shaped recovery, but as drawn by a very shaky hand. So he kind of expects there to be fits and starts with the recovery. But broadly speaking, this is Vanguard's forecast. I would say of all the forecasts I've seen, this is pretty representative, where most are expecting U.S. economic output not to fully recover until the end of 2021. That seems right in our estimation. You've seen some forecasts slightly more optimistic, some slightly more pessimistic, but we feel as a baseline, kind of this swoosh shape is the right expectation we should all have. And it's important to recognize then if that's kind of the consensus, that's likely what's very much embedded into securities prices. So in order to have a more optimistic view on stocks or the economy as a whole. You need to think that you're going to do something better than this recovery. In order to be very pessimistic, you would expect things are going to come in worse than this. But I think this seems like a good baseline for people to kind of orient to. Very briefly, and this is why we think so. We think there's going to be a swift kind of technical bounce. So again, I mentioned a annualized GDP decline of roughly 35% in the second quarter, followed by a gain of in the 20 to 25% during the third quarter. That seems right, as you just have reopening is going to naturally be followed by a sharp recovery from a technical perspective. But then recovery from there should slow down. And I think there's a number of reasons on why that's likely to be the case, right? We have social distancing, whether it's government mandated or simply voluntary, as many at-risk portions of the population simply are going to be uncomfortable going out and operating at full capacity or spending at full capacity. That seems only natural. As a result of that, you're going to have impaired global supply chains as economic reopenings are going to be uneven and not uniformly coordinated across states, across various regions, and then even more broadly across countries. And so that's just going to cause some disruptions in the supply chains of any types of manufacturing or goods intensive businesses, and to a lesser extent than even on service businesses. Debt overhang is going to be certainly, we think, will play a role in holding back the recovery. So, right, as we've talked about, companies have taken on massive amounts of debt to tide themselves over from a liquidity perspective to be able to ensure they're able to pay bills during the shutdown phase. Just this additional debt taken on by businesses and to a lesser extent households during the crisis, it's likely in our perspective to weigh on spending and risk-taking activity again, so constraining demand and supply within the economy. Time is just another factor that's just going to have to play out, which is there will be businesses that are going to permanently shut down as a result of this. There are going to be jobs that do not come back. And as we've seen in every recession and crisis in the past, these things simply take time for both capital and labor to allocate from losing sectors and companies to winning ones following these disruptions. And then I would say the political environment is another key source of risk, or better put, uncertainty in the market. And I think that's just going to weigh on demand and supply in the economy, as well as we have a variety of outstanding or elements of policy that are going to be uncertain, ranging from tax policy to regulatory policy to trade policy. And it's hard to envision that doesn't weigh on economic growth and recovery to some extent looking forward. Importantly here, and this is something we wrote a commentary about recently, it's important that we all recognize that the stock market and the economy are not the same thing. So the chart on the right side of the page presents on a quarterly basis, quarterly GDP growth and that same quarter's return for the S&P 500 index. And what you see is here just a big blob of dots. What that signifies is that there is essentially no statistical relationship empirically between contemporary GDP growth and stock market returns. We have not yet received the second quarter real GDP number, but we do know basically it's going to be very negative, probably off the scale to the left of the horizontal axis. But we also know that we saw a plus 20% return. So you're going to see something in the very far upper left quadrant when that data point is ultimately released. Our commentary did talk about, and we covered this also in a podcast recently, there's a number of reasons why the link between economic growth and contemporaneous stock market returns is low. First of all, stocks derive their value from their earnings, not from economic growth, not from labor market growth, et cetera. And importantly, too, it's long-term earnings, not just single quarter, single year earnings. So to the extent that those aren't perfectly mirrored, you would expect the link to be weak. Additionally, the domestic economy in which stocks operate is often very different from where they derive their revenue, expenses, and ultimately earnings. So that will further weaken the link. And then most importantly is really that the stock market is a forward-looking mechanism. And so the stock market trades not on good or bad, but better or worse, and how are things coming in relative to expectations already embedded in prices. And so to the extent things are getting better, are coming in better than previously expected, you would expect stocks up, and conversely, when things are worse than expected, down. And so cumulatively, those three just work to entirely sever any type of a statistical relationship between the two. And this is lastly kind of another chart that we've shared in the past, which is, again, representing the forward-looking nature of stock markets, which is that you've seen historically the stock market has led the economy in the sense that the market has bottomed historically during past recessions dating since World War II. The market has bottomed roughly 4 to 6 months prior to the economy, with one lone exception being in the aftermath of the dot-com bubble. But generally speaking, stocks have bottomed well in advance of the economy and delivered some very sharp performance before the economy has officially exited a recession. As with all things in the current episode, this is likely to be, show a very compressed relationship. So I mentioned before, the recession officially started in March. It's very possible that when this is all said and done, we'll have declared that the recession ended in either May or June, in which case you'll have seen if the stock market ultimately did hit its bottom in late March there, you'll have seen in this case it'll probably have bottomed 2 to 3 months in advance. So a little bit shorter, and also we've seen, the 35+% gain from the bottom, potentially before the economy has exited the recession. So nothing unusual other than the fact that probably just compressed during the current episode. One thing we are looking at is just, one I'd call it source of risk, potentially the downside of broad markets here we continue to look and think earnings at estimates or forecasts might be a tad bit on the optimistic side. So we can see in this chart, and this is something we covered in a recent commentary, but trailing 12-month or 4-quarter S&P 500 earnings over the past, and we can see analysts both top-down and bottom-up estimates. So top-down just saying kind of for the economy as a whole, bottom-up, the aggregate of individual company forecasts. Historically, you tend to see top-down tend to be a tad bit biased on the upside relative to the bottoms-up one. But right now you're seeing a forecast for the year in its entirety. The analysts are forecasting a decline of somewhere of 20 to 30% for earnings. You can contrast that with the 2001 to 2003 recession. Earnings ultimately declined by 32% on a full year basis. During the financial crisis, it was closer to 60%. So we do look at this, in particularly the fact that forecasts, and these were as of a couple weeks ago, but forecasts were for earnings to fully recover by year-end 2021. Again, we look at that as maybe a slight bit on the optimistic side, or put it differently, we expect we're far more likely to be surprised to the downside than we are to the upside. And so that could introduce a source of risk to the market as a whole. Not dramatic, but something, again, we think does warrant or supports our kind of current positioning within equity portfolios of being on the modestly defensive side as we're currently positioned across many client portfolios. And lastly, just 2 more slides I'll cover here before opening up to questions. We've received a handful of questions recently about the upcoming elections and whether or not we think it warrants action within portfolios. And this is one thing I'd say emphatically, we do not. We firmly advise against investors allowing their political beliefs or forecasts about the political environment to influence their investment decision making. And for the reason being is that in this first slide here, we see party affiliation tends to have a very strong impact, perhaps an undue or inappropriate one, of our assessment of economic conditions. And so what we look at here is this is a polling that's done by the Pew Research Center, where they ask people their assessment of economic conditions today or at the present. And you see that very strong affiliate party line divides on these. And you see, Republicans consistently assessing the economy more favorably during the years of the Bush presidency. Big gap there between Republicans in red and the Democrats in blue. You did see everybody on an absolute basis, throttle back their assessment of the economic conditions during the financial crisis in the 07-08 era years. But you did see, shortly after Barack Obama's election and ultimate inauguration in early 09, you saw the relative relationship flipped dramatically, where Democrats consistently assess the economy on better terms than Republicans. And then lo and behold, you move into late 2016 and into early 2017. Following Trump's victory in the 2016 elections, Republicans once again viewing the economy much more favorably than Democrats. And so, it's not hard to envision scenarios, and I vividly remember episodes from the 2008, 09, 20, even in 2010 and beyond, Republicans telling me or expressing their concern about policies promoted or ultimately enacted by Democrats, and expressing their concern and significantly throttling back or avoiding, equity markets altogether. I also remember vividly a prominent columnist in the New York Times, who's a Nobel Prize-winning economist, predicting that with pretty significant amounts of confidence that we would experience a Great Depression-like scenario shortly after Trump's inauguration. That, as we know, hadn't come to pass. And so advising people to avoid stocks, and many of others been afraid of Trump's policies and have avoided risk assets in recent years. And what we've seen is, just here on the last slide, is that anybody who had allowed their political persuasions or views to cloud their investment decision making possibly missed out on significant investment opportunities. So just during an annualized basis during Obama's presidency, the stock market returned just more than 15% annualized. You've seen then similarly of somebody fearful of Trump would have missed out on significant gains during the last 3.5 years to this point. So something that we just look at, we think people should avoid with a certain degree of humility and ideally not allow political judgments to cloud their investment decision making. So that was the extent of my prepared remarks. Maybe I'll open it up and see if Nick received any questions through the Q&A.
Yeah, thanks, Nick. Yeah, we did. So one question came in, especially as you were talking kind of towards the end there, on what can happen after you've had these periods like what we're in right now, where the market's down hard. And one question came in and said, if there's news of a virus treatment, excuse me, or vaccine, like a solid phase 3 trial results, I would assume that value stocks will soar. Should investors look to add exposure to value stocks as we approach the end of the year?
Yeah, so it's a great question, and there's a couple things to unpack in there. So you have seen again, it's always challenging on a day-to-day basis or really over any period to understand exactly what's driving markets, but the prevailing conventional wisdom right now, which seems to hold true, is on these days in which case we do get good news about the virus, specifically as it relates to progress of vaccines or even other treatments, that you have seen the market move sharply higher, and you've seen a distinctive pro-cyclical bent. Specifically, you have seen smaller companies and value companies tend to outperform dramatically on days like that. Yesterday was a great example of it. We saw the broad market as a whole up about 0.5%. We saw good news on Moderna's vaccine trial progressing as they've continued to expand into additional phases. And you saw during that period where the market as a whole up about 0.5%, you did see small cap value stocks. We were really kind of that the most cyclical of them all up north of 4.5% yesterday. So, I would say if somebody had a lot of conviction in the belief that good news is likely to come on the vaccine front and on the virus front, that adding small cap and value to your portfolio seems to be an appropriate play. One I would agree with. I always try to advise some caution with our abilities to forecast future events, but if that was one's belief, I would certainly agree with that. On a factor, what I'll call that, broadly speaking, would be factor tilting or timing. So we generally believe in the efficacy of all these active index styles or factors. There's some research that suggests that they are correlated to economic cycles, and that there are ways to, modestly over or underweight factors relative to a neutral perspective. Incidentally, within our client portfolios right now, we do have a modest bias relative to neutral towards value. It is something that, just on the basis of its extended underperformance and a few other metrics, simply we can look at things like quote unquote the value of value are very attractive right now. Plus, just the case for recovery as a whole. We do think that we do look at value as a factor right now as a pretty attractive one.
Perfect. Yeah, I think that goes in line too with what I've been hearing just from some conversations that we've had with clients about coming out of other recessions, similar to the great outperformance in the dot-com bubble of growth versus value, and then, the call it kind of return to the mean, if you will. So no, that makes sense. Thanks, Nick.
Yeah, it's
Another,
a great point. You brought up coming out of the dot-com bubble, for instance, and a lot of I think directionally we are similar in terms of the extensive outperformance of large cap growth, and the flip side, the significant underperformance is small and value. During the 2000s, then, and again, I don't think we are nearly at the same magnitude in terms of I'll call it, for a lack of a scientific word, craziness as we saw in the late 90s, but directionally similar. And what we saw during the 2000s, for instance, was right. It's known as the lost decade because during that 10-year period, the S&P 500 index was down, I think, roughly 0.2% on an annualized basis. But the whole market, not every segment was. You actually had small cap value stocks return north of 5% per year during that period. So this is where we do look, and we try to have some humility in these quote unquote tactical positioning, but we do favor things like value looking forward, even if we do have some concerns on the large cap growth segment.
Yeah, no, that makes a lot of sense. And then one other question came in as we're kind of wrapping up here. So can you elaborate on where we should be investing in light of the unbelievable U.S. government debt going forward?
Yeah, so it's something we're continuing to research, try to understand the implications of. One thing is, you have seen a closer coordination between fiscal and monetary policy. I did show that chart of the interest servicing costs of the outstanding debt and how important it is that, or how significant the impact of low interest rates are. I think all else equal, that would suggest, the Fed will not explicitly come out and mention it, but I think they are certainly aware of that dynamic, and the Fed will do what it can to hold interest rates low. I think there's, the Fed probably gets overemphasized on its impact on market interest rates, particularly you start thinking about 5-year, 10-year, 30-year bonds. The Fed's impact is relatively more limited there. I think there's a number of reasons why interest rates have come down low. Economists broadly seem to agree there's some combination of, excess savings in the market, as well as a shortage of demand for capital, which is just all in all work to push interest rates lower. And I think rates will stay lower, and I think the Fed will probably take extra steps to hold interest rates lower. So there are some impacts there, right? That if risk-free rates over the very long haul, if an investor could get 4% a year from just lending, intermediate or buying intermediate term treasury bonds, lending money to the federal government, something like corporate bonds or even, stocks needed to offer some amount of an attractive return premium in excess of 4%. If that rate now is zero, the risk-free rate is zero, or for all intents and purposes zero, call it 0 to 1%. If that's now 3%, 4% lower than it's been historically, I think it makes sense for investors to also then, ratchet back their expectations for what type of return stocks should give going forward. And so maybe if over the very long haul stocks have done 10% a year, but you've had a risk-free rate of 4, let's just say that excess premium still holds in a 6. Maybe now instead of expecting 10, you should be expecting, 6 to 7 on stocks, which I think is reasonable, as I mentioned earlier. Some of the other implications we haven't fully wrapped our arms around will be, what does this mean for inflation? Certainly, I think that is the greatest risk of massively exploding deficits and outstanding debt. Something that we'll continue to understand is to what extent should we be concerned about inflation. I certainly don't expect or think inflation is a significant concern in the immediate term. However, I can see inflation rising in the years ahead. And maybe instead of it just being inflation of 1 to 2 that we've become accustomed to, maybe it's 3 or 4. There's certainly I'll call a significantly negative scenario of inflation returning to 80 style. I don't think that that's a likely outcome, but something, our team's going to continue to do research on, something that I think a lot about. What are the implications of all this? And I'm sure we'll have more updates in the coming months.
Okay, great. Well, thank you everybody for attending today. We really appreciate your time, and we're going to respect it and get off here right at 11 o'clock. So thanks, Nick, for going through all of this and giving us a great overview.
Yep. Thank you, everyone.
Take care.